I'm looking at a bank statement from 3 years ago, and I honestly felt sick to my stomach when I realized I'd left $12,000 sitting in a basic checking account that earned 0% interest. While I was busy stressing about my credit card minimums, that cash was literally losing its value every single day because of inflation. I thought I was being safe. I thought I was being smart by not risking my money in the market. But the reality is that by never investing it, I was actually paying a hidden tax to the economy. In the next 10 minutes, we're going to run the math on exactly what that safety cost me, and more importantly, how you can stop the bleeding starting right now. I've seen people lose $40,000, maybe $50,000 in potential growth over a decade just because they were too afraid to move their money out of a standard savings account. If you've ever felt paralyzed by the idea of investing, you're not alone. We're going to walk through the difference between a high-yield savings account and the stock market, and why doing nothing is the most expensive decision you'll ever make. Let's start with the math that nobody tells you. If you have $10,000 sitting in a traditional big bank savings account, you're likely earning 0.01% interest. That's $10 a year. Meanwhile, inflation, which is just the increase in the price of goods and services over time, has been hovering around 3 to 4%. That means your money is effectively shrinking by $300 every single year. You aren't just earning nothing, you're paying $300 a year for the privilege of letting the bank hold your money. It's like buying a cup of coffee every day and throwing it directly into the trash. Does that sound safe to you? Because that's what happens when you prioritize liquidity over growth. You might think you need that money ready for an emergency, but an emergency fund doesn't need to earn 0.01%. It needs to be in a high-yield savings account, or HYSA, which is just a savings account that pays you a higher interest rate, often 5% or more, because it's online only and has fewer overhead costs for the bank. If that just clicked for you, hit like. It tells me to keep making this. When you move that same $10,000 into a high-yield account earning 4%, you're suddenly making $400 a year instead of $10. That's $400 for doing absolutely nothing but changing where the digits live on your screen. It's not about getting rich overnight, it's about stopping the erosion of your hard-earned paycheck. Most people I talk to are terrified of the stock market because they think it's gambling. But there's a difference between picking individual stocks, which is high risk, and buying index funds. An index fund, that's a basket of hundreds of companies that lets you own a tiny piece of the entire economy, is generally considered a much more stable, long-term way to build wealth. If you have $10,000 in an index fund that grows at an average of 7%, you're looking at $700 the first year, and then that number grows because of compound interest. Compound interest is simply the interest you earn on your interest. It's the closest thing to a financial superpower that actually exists. Let's look at a real-world scenario. Imagine a 25-year-old named Marcus. Marcus works a standard office job, makes $45,000 a year, and has $12,000 in debt between a car loan and a medical bill. He keeps $5,000 in his checking account because he's scared of running out of cash. For 5 years, that $5,000 sits there. It earns absolutely nothing. If Marcus had taken that same $5,000 and put it into a broad market index fund, and added just $200 a month to it, after 10 years, he'd have over $45,000. By playing it safe and leaving it in his checking account, he essentially threw away nearly $30,000 of future security. That's money that could have paid off his entire debt load twice over. The shame of not knowing what to do is what keeps people stuck. But you don't need to be a Wall Street expert to fix this. You just need to stop letting your money sit stagnant. Tell me your biggest debt right now in the comments. I read every single comment, and I want to know what's holding you back. Is it a credit card, student loans, or maybe something else? Knowing what you're dealing with helps me make better guides for you. Millions of people in exactly your situation have figured this out. You aren't the only one who feels like they're underwater. The trick is to automate your progress. If you're struggling with debt, don't try to invest and pay it off at the same time if the interest rate on your debt is higher than what you'd make in the market. If you have a credit card at 24% interest, pay that off first. That is your highest investment return. But once that's gone, don't just leave your money in a 0% account. Move it to a HYSA, then start a Roth IRA. A Roth IRA is a retirement account where you pay taxes on the money now, but it grows tax-free and you can take it out tax-free when you retire. It's one of the best tools for the average person to build a real cushion. Now, let's talk about the what-if anxiety. What if you need the money for a car repair? What if you get laid off? This is why you need an emergency fund. An emergency fund is 3 to 6 months of your basic living expenses that you keep separate from your fund money. This is what buys you peace of mind. If you have $1,000 in your checking account, that's your buffer. Everything above that should be working for you. If you're scared, start small. Put $50 into an index fund. Just see what happens. Watch the fluctuations. Most people realize that once they see the money growing, the fear turns into excitement. It's the difference between feeling like a victim of your finances and becoming the captain of your own ship. You're not trying to beat the market, you're just trying to participate in the growth of the world economy. I want to address the "I don't have enough money" excuse. I hear this every single day. People think investing is for the rich. But the math doesn't care about your salary. It only cares about your consistency. If you only have $50 to spare at the end of the month, put it into an index fund. That $50 is an employee that works for you 24 hours a day, 7 days a week. It never asks for a raise, it never gets tired, and it never calls in sick. If you're a gig worker, this is even more critical because your income is unpredictable. Use a 1099 tax deduction, those are expenses you can subtract from your income to lower your tax bill, to free up extra cash, and put that into a high-yield account. Every dollar you keep out of the hands of the government is a dollar you can put into your own future. If you know someone who is just paying minimums on their cards every month, send them this. They need to see that the math is actually on their side if they just change the strategy. Let's break down the cost of waiting one more time. If you wait 5 years to start investing $500 a month, you lose out on hundreds of thousands of dollars by the time you're 60. Time is the only asset that you can never get back. You can always earn more money, but you can't earn more time. The current economic climate, with the Fed holding rates, means that high-yield savings accounts are actually paying well for the first time in a decade. You are currently in a window of opportunity where you can get 5% returns on money that is practically risk-free. If you leave that money in a big bank account, you are literally choosing to lose money. It sounds harsh, but it's the truth. Take 10 minutes today to look at your bank's interest rate. If it's less than 4%, move your money. It's free to open a new account, and it takes about 15 minutes online. You might be asking, what about crypto? Crypto is highly volatile. It's not an investment for your emergency fund or your core savings. If you want to put 1% of your money into it, that's your choice, but it shouldn't be your retirement strategy. Focus on boring, consistent growth. Focus on index funds. Focus on tax-advantaged accounts like the HSA, the Health Savings Account, which is a triple tax-advantaged account you can use for medical expenses, but also as a secondary retirement account once you hit 65. Most people don't know that the HSA is the most powerful investment vehicle in the tax code. Use it. Once you've paid off that high-interest debt, every dollar you put into these vehicles is a step toward true financial freedom. We're at the end of this, but this is really just the beginning of your journey. You've learned that your money is losing value every second it sits still, that high-yield savings are your best friend for emergency cash, and that index funds are the path to long-term stability. If you found this useful, subscribe. I'm going to be doing a deep dive next week on how to navigate the debt avalanche method, which is the fastest way to kill your high-interest debt while still keeping a small amount for your future self. It's titled The Debt Avalanche: How I Paid Off $18,000 in 11 months, and it's going to be the most practical thing I've ever released. Remember, you're not alone in this. Millions of people have been exactly where you are, and they've made it out. You can, too. Just take that first step, move that money, and stop letting inflation eat your hard work. You've got this. I'll see you in the next one.